Hi everyone. Uh, Hello and welcome to this the second edition of our Tuesday talk. Uh, Wishing all of you a very happy Eid and a very happy Akshay Tritiya. Incidentally, the topic we are going to talk about today also has something to do with Akshay Tritiya. It wasn't planned; it just happened that way. So something that's meant to happen. Uh, so besides what we usually cover in the Tuesday topic, which is how the factors of the sectors behave during the week, month, and year till date. We also take up a topic and we've come up with a strategy which answers a fairly common question that one gets at any party or any conversation. Once somebody understands that once somebody hears that you are an investor and wants to know about, they'll say market kya lagta hai, how does it look for the next 1 month, 3 months, 6 months. You never know. They just ask market kya lagta hai. It's a very, very open-ended question. Or they'll be like, where should I invest my money this month? I've got this lump sum and what should I do with it? And I think the way to answer that question is for us quantitative investors is to uh, figure out in whether it's in risk on or the risk off environment. And that I think if you're investing for the long run in equities, then it doesn't matter really. But not all of us are going to do that all the time. There is a percentage or a portion of our portfolio which can be a bit tactical in nature, where you can take some action, and we'll talk about more about that when we get there. So with that, let's get started. Uh, so like I said, we'll cover the factors, the sectors, and excited to bring you the factor all weather. This is about us. We're a SEBI registered PMS firm, one of the first, perhaps the first quant-driven PMS in India, with a very transparent, rules-based investing approach. We've been around for over 5 years now. So with that, the weekly factor performance. So values finally, had uh, uh, fall this week after a very long time, and slow volatility, which has sort of taken its place, or at least has managed to be in the green. But the rest of the factors, quality, momentum, small cap value, all down this week. No surprises. Um, Low wall again for the month. I remember this is as on April 22nd, April 2022, which is Friday last week. The momentum again is is taking it on the chin. It's a volatile factor, so that is bound to happen. If you are going to be there for the upside, you better be there for the downside too. Year to date, value sort of is just about break even. Small caps taking it on the chin, down about 8%. The market, the broader market, is surprisingly strong, down just about 2 to 3%. And compared to markets in the US like Nasdaq is down almost, is in the bear market over 20% now. So we're doing fairly well compared to those markets, and it's quite surprising. In terms of trend, it's still value which is in an uptrend, just barely about there, but all of the other factors, including low volatility, are in a downtrend till now, so no change there. With that, let's look at the sectors. So low vol was the factor which was up or sort of gaining some traction. So usually FMCG is a low volatility sector which comes in that. Autos have done okay. Banks are just about flat. What's taking it on the chin is media, perhaps on the back of I think there's one stock TV18 broadcast which had a pretty bad week last week, and we used to have it in one of our portfolios. We got an exit the week before. Luckily, we had no major insight on that. It's just a system managed to catch it in time and exit. But yeah, media was the outlier sector, and IT was again down about 2%. Metals down a bit, so and also energy. For the month, however, energy still leading up about 8%, FMCG is up about 4%, and IT is down 13, media is down the most, not the most, second after that 11%, and year to date again, energy, metal still are the best performers, and IT is the worst performer with down 18%. With that, let's look at the trend. So auto, FMCG, media, surprisingly still in an uptrend. Metals, energy, infra, still in an uptrend. But rest of the other and higher weightage ones like bank, IT, and finance, they are in the downtrend, and I think that's the push and pull between these two sort of, there will be six sectors up, five sectors down, so that's sort of keeping the market just about down 4%, 3%, 4%, and not as much as we see in the US. But let's see, on the 4th, which is tomorrow, we have the Fed decision, so let's see what comes out of there. It's going to be interesting. Again, if you want all of this in your inbox, just subscribe to the Factor Investor report on Substack, and you'll get everything there. So with that, let me come to the topic of the day. Before that, just a couple of things on asset allocation. This is one of my favorite topics. Just let me reiterate. I've covered this before, but what is strategic asset allocation and what is asset allocation? Asset allocation per se, we know, is basically allocating between asset classes like equity, gold, bonds, and defensives like precious metals. Strategic asset allocation is if you've decided the weight in advance, like say the most common strategic asset allocation portfolio is the 60-40 portfolio, which has 60% equity, 40% debt, and which is rebalanced once a year if the weights go out of whack, say 70 goes to 80, and subsequently the 40% debt falls to 30, then at the end of the year you would rebalance it back to 60-40. Tactical asset allocation, on the other hand, is an interesting strategy where you do take some amount of active calls, again using quantitative strategies, and you do some amount of market timing, but over a long to medium term. It's not like a short term trading kind of portfolio. And this I suggest can be used as a satellite to your core market portfolio, that you're holding. If you are holding index funds or any other core portfolio that you're holding, this is a good one to sort of tactically manage your exposure in the short run. Some popular asset allocation strategies which I like in the tactical space are Meb Faber's and Gary Antonacci's dual momentum. Meb Faber's has something called the quantitative asset allocation strategy. Again, I've spoken a lot about it in the past, so and maybe at some point in time I'll cover it again. It's always good to use a couple of strategies because you need to diversify among strategies. It's not just among assets, because nothing works in a smooth line. In the long run, it all looks very smooth, but in the short run, a period like this, when things get turbulent, is when a bit of diversification helps. With that, coming to the main topic for the day, the factor all weather, which we've been working on for a while. We've been thinking of, what would be a good all-weather strategy when nothing is working. And Akshay Tritiya, it's when you, when the environment gets defensive, the one asset class you would go into is gold. So let's see how you would do that. Sometimes people think about that, if you're doing some amount of market timing or some amount of tactical asset allocation, that's going to help you to outperform. The intention is exactly the opposite. The intention is to help you to lose less in a in a bear market or in a major decline. That the intention is not to make more. You might, for the last 10 years, for example, where the US and other equity markets have been in a long-term uptrend, you perhaps may have made a little bit less in if you were using a tactical asset allocation strategy, but you would have also seen fairly lower drawdowns than a buy and hold. So it's not about getting more upside, it's about protecting the downside and managing losses, which is what a tactical asset allocation is all about. It keeps your recovery, it, it keeps the length of the decline much lower and the recovery much faster compared to a buy and hold usually. Now, so instead of complex asset allocation, we believe in using simple asset allocation. Again, with a lot of research, it's been proved that 1/n is a fairly good strategy where you're doing equal weight allocation, unless you're doing into a number of stocks, and then you can get into other complex strategies, position sizing strategies like risk parity and volatility and things like that. But most of the time, simple asset allocation 1/n, which is where n is the number of assets, that works pretty well. Instead of story-based stock picking, we focused on evidence-based selection. In this case, the building blocks of what we want to use for our equity exposure are momentum, value, and quality factors. And instead of no downside protection, which is what you do in a buy and hold scenario, the whole point of using a tactical asset allocation strategy is to have some amount of downside protection, which I had explained earlier. This framework is from Alpha Architects. We've shamelessly taken it from there. So thanks, Wes Gray and Jack Bogle. But it's a very good way of explaining what and how and what is the purpose of doing tactical asset allocation. The next concept I want to just talk about is a risk on, risk off concept, which some of you may have heard of, some of you are hearing for the first time. But a risk on environment is usually when you are investing in riskier assets, the riskier assets being equities, and risk off environment like we are in right now, or we're getting into right now in other countries, is where you get into more defensive asset classes, which is something like gold right now, short-term bonds, not long-term, because we are in a rising interest rate environment. So long duration bonds are not the place to get defensive. It would be more short-term, short duration bonds. What does Investopedia says? When stocks are selling off and investors run for shelter to bonds or gold, the environment is set to be risk off. And when investors like to put money in riskier asset classes, the environment is set to be risk on. This is from a site called Allocate Smartly, where they've taken some 65 asset allocation strategies and then come up with just an average sort of risk on, risk off. So you can see when this is perhaps the period during COVID when it's ending, the one that looks like a big U at the end, where the red curve is up, which is the risk off environment, and the green curve, which is the risk on allocation. This basically gives you the allocation between risk on and risk off. Average allocation for the previous 24 months. You can see how it's changed during that turbulent period. Coming to a bit more specifics about the factor all weather, it's a combination of a couple of tactical asset allocation models. For risk on, which is basically equity exposure, we're taking 3-factor funds, like I said earlier, momentum, value, and quality. For risk off, we're going to use gold, which is, again, I'll show you on the next few slides why we're taking gold and why it's called an all-weather asset. Now, post the global financial crisis in 2008, you can see on the graph, the bar chart, that central banks have been one of the largest buyers of gold globally. and we're in the midst of of once in a lifetime, truly once in a lifetime economic monetary experiment, because no one's seen this or done this before, where we've had such huge expansion of central bank balance sheet, and and you can see how the central banks are acting. They're basically protecting themselves and their balance sheet by just backing the truck up on gold, because even they don't know, I think, how this is going to end. The other reason is that gold has a negative correlation with other classes. Couple of papers written, the source for which is given below, one by the RBI, which is performance of gold as a financial asset during different phases. You can see this here, and by my friend Rajan, which talks about historical, nominal, and real asset returns in India. And you can see in the table below where that gold has a negative correlation to equity. The Nifty 500 is a proxy for equity. The 5-year benchmark G-Sec index about negative 3.5, and to the S&P 500 again in INR a negative 4. So it's tough to find asset classes which are negatively correlated. So, and it's good to use them to sort of, when you're going in and a risk on, risk off kind of model, it's important to have these negatively correlated assets. Otherwise, you might as well hold on to the one which you are already invested in. So that's again in India, gold. One of the reasons why gold goes up also in INR terms is because of rupee depreciation. So it has a positive correlation with dollar strength. When USD rises, gold in INR also tends to rise. So it's also not just negatively correlated to equities, it's also a good currency hedge for us. Now, in times of crisis like 2008, 2020, and even now, where we're in the midst of, again, unprecedented times, where we're seeing inflation in the US, which is at a 40-year high. The Fed suddenly changing its stance from saying inflation is transitory to now inflation is sticky, and that they will do all that it takes to counter inflation. It's natural that investors will panic. Investors will start going into a highly risk-averse mode, because macros are, how they're going to act, how they're going to behave is very, very tough to predict. So we have high inflation, interest rates going up. The economy seems strong in the US, but the impact of the invasion of Ukraine is now showing up in energy prices, and it's Europe which is getting affected a lot more. So what happens is that if you have a satellite strategy, you want to do something, you want to take some action, and if you have a satellite strategy, you have a tactical asset allocation strategy. You make some adjustments to your portfolio, not for the sake of it, but to protect your portfolio, and it also helps you to stick to your strategic core portfolio, because you take some action, limit some amount of downside. So you're taking some appropriate action and protecting your portfolio in these confounding times. So with that, let me go on to the risk off model. The building blocks of equity or a risk on environment for us, what we're going to use are the proxies for momentum, quality, and value. We've taken these funds and ETFs because they are the ones that are available currently. For value, I would have liked to take a much more broader index, the Nifty 500 value 50, but unfortunately, there's no ETF or fund available for that. So we'll stick with the Nifty 50 value 20, quality, fairly decent index, and the Nifty momentum 30. And we have funds and mutual funds and ETFs available for both. So we offer all three. So we're going to use that equally weighted. For risk off, we've used gold bees, but you can use any gold mutual fund or any other ETF which has a low tracking error, low cost. Gold bees are the one that have been around for the longest period of time, so we've used gold bees. The rebalance frequency is on a monthly basis, and so the way it works is that, if let's say the model gives us a signal to exit, say we are 100% risk on and we are equally invested in momentum, quality, and value, uh, and we get a signal to sort of exit quality and just hang on to momentum and value. So what the model does is it will exit quality and invest that portion in gold. So one third of the portfolio will go out, which is quality, and that will get invested in gold. And that's how it will work for momentum and value. And if the environment is 100% risk off, the entire allocation is into gold. This is a graphical summary of since 2018, and you can see how the allocations have changed over a period of time. We've sort of come out of a fairly long risk on environment of almost 16 to 18 months, where we were fully invested in equities, and now since February onwards, we've started getting into gold. Again, this month, the model is 100% in gold. Some case studies. To give you an idea, how the model transitioned and how it worked, I spoke about it earlier. So this was the holding, say, from November 2019 to Jan 2020, where about one third was invested across the Nifty momentum, quality, and value indexes, the funds or the ETFs rather. Then in February of 2020, gold came in the place of value. Momentum and quality were still there, but the transition had sort of begun. And this was, in mind you, in February when we had no lockdown. We didn't even know there was going to be a lockdown or anything of that sort. In March, even quality went out, and so we were 2/3 in momentum and 1/3 in momentum, 2/3 in gold. And by April, we were by the 1st of April, we were fully in gold, and April, May, and June, the factor all weather was completely in gold, invested in gold. Now let's see how you transition if you get into risk off, how you transition back into a risk on mode. So in July, the transition began before any vaccine came, before there was any confirmation, how many waves we'll have. But this was post the QE that the fourth QE4 that the Fed had done. So July 2020, 1/3 went into the momentum fund. We are still 2/3 in gold. This by August, we were fully in risk on mode. So the other 2/3 also got deployed in the quality and the value fund. And and then from there, from August 20th to Jan 22nd, the model was completely invested in equity. Now you can see here how from Jan 22 onwards, which is the beginning of this year, in February again, we started the risk off mode started. About 1/3 was allocated to gold, and by March it moved fully to gold. In April, as the markets tried to bounce back a bit, in March, as the market tried to bounce back a bit, the model made some amount of attempt to get back in and allocated to a couple of factor funds. But by today, on the 3rd of May, we ran this model on 1st of May. So it is back to 100% gold. So, we are, as per the model, we are completely in a risk off mode right now. So the thing that I was talking about, Feb 22nd, about 1/3 moved into gold. Quality went out, value was still there. and momentum was also still there. But by March 22, 1st of March 22, we were completely fully risk off mode. So these are backtested returns from Jan of 2010 to April 2022. So the model is given a return of about 17%. But look at the drawdown compared to the Nifty 50 buy and hold. The drawdown is less than half of the Nifty 50 buy and hold. And the Nifty 50 is given a return of about 10% in the same period, with higher volatility of 17% versus the factor all weather, a volatility of about 13%. We've been running this model live from Jan of 22. We've been tracking it live since then. Like I said, this is something that we are going to put on the website as a dashboard where you'll be able to see it. This is just a graphical representation of that, how you might be able to see it. You'll see it in the form of the half donut graph that you see below, which tells you exactly, how much and where the model is currently invested. The other way, if you want to just, use it as a gauge of the environment out there, you can see it as a risk on or risk off. So you can see in April, about 57% towards risk on, which was made up of momentum and value. And by May, we've gone back to risk off completely. These are the assumptions that we've made. We're taking completely price data, so no, these are not total return indexes. So no, the dividend of about 1.5% is not factored in the returns that we showed you here. So this could have been higher by about 1.5% had we taken total return index. Instead of 17%, it would have been about 18.5%. But neither have we taken any transaction costs or any taxes. So it's it sort of sets off for those and provides some amount of cushion for that. So on average, how many decisions does the model make? About on average 2 decisions a year, so maybe once every 6 months, but that's on average. For example, I showed you that from August 2020 to January 2022, there was no change in the model. It was completely and fully invested in equity. So most of the time, you will probably see long-term capital gains and short-term capital losses when the model makes some changes in a short period of time. Currently, this will be available via PMS offering. We've not yet decided on a small case version of the same because what we found is that asset allocation models, there's not too many takers for that. But if you think that you want a small case version of this, please let us know. We'll try and put that up. Otherwise, this is going to be available for our PMS clients. We're also preparing a dashboard on our site. If you're a DIY investor and you want to say that, Anish, I can do it myself. Why should I be paying you the money or buying a small case? Okay, fine. We don't mind. Just go to our website, and when the dashboard is live, we'll let you know. I'll show you on Excel, some amount of functionality of what is going to be on the website. We'll have all the historical allocation and returns from January 2010, performance during specific crisis periods. The model will be updated on a monthly basis in the first week of the month. We'll try and do it by the first or second of the month so you can take action if required. We'll cover it in our Tuesday Talk videos, and we'll also publish it in our Factor Investor Substack. So if you want to subscribe there, you can. So via all these 3 mediums, we'll be communicating this to you. With that disclaimer, this is not investment advice. This is just purely for educational and informational purposes only. Let me show you the Excel version of it and some amount of what will look on the website. So we are working on the website. This is what probably it will look on the website. The colors and the presentation and the font and all of that will change a bit. But if you can see, this is the model that I showed you. You can see it like a gauge here. This is the allocation. And these are the historical allocations. So it will be available for you to see how much was allocated in what at any period in time. It will be available in the form of a table also. So if you want to just download it and see it, and we'll also be putting the risk on, risk off gauge that I spoke about. So now, if this is May 22 with the current allocation. Now, if you wanted to go back and see in history that what was the allocation during say the 1st of January 2020 or the 1st of January, what was the model suggesting? It was completely in risk on mode, as I showed in my presentation. This is pre-COVID. I'm purposely taking this one to show you the transition. On 1st of Feb, it moved 1/3 into risk off, and then 1st of March, another 1/3 got peeled off and went into risk off, and then on 1st of April, it went completely into risk off. So you'll be able to do this, all of this on the website. We'll be giving this functionality to you guys, and so anytime in the middle you want to see how was the model, it's completely in risk on. Post July, I think of 2020. I think June. Okay, June was risk off, and then from July onwards, started going into risk on, and by August it was completely in risk off mode. So this is one way to use it if you want to just take a temperature of the environment that we are in. You can just sort of use this gauge, and you can go back historically and also see it. And if you want to see how much is invested, how much is the risk on is invested where, you can even this breakup will be available. For example, in Jan 22, we were about 1/3 in across momentum, quality, and value funds. In February, you can see that we moved out of quality, and about 1/3 of that went into gold. In March, completely went to gold. In April, because the markets were good in March, the market tried to make a comeback. We went back into momentum and value, but 1st of May, things are back to gold. So, that's how the model is going to work. So thank you, guys. I welcome your comments. I welcome your, please subscribe to our channel, ask us any questions, send us your feedback. You can, these are our Twitter handles. You can tweet at me or at our company handle QEDCap, and we'll respond to you as soon as we can. This is our website, and as soon as we have the model live on the website, we try to make like a dashboard where you'll be able to see it, current allocations as well as historical allocations of the model. You'll be you'll be alerted and you'll be intimated. So subscribe to our newsletter on our website, which is free, or to the Factor Investor on Substack. And anyway, we try and put it on social media also as we go along. So with that, again, wishing all of you a very happy Akshay Tritiya and a very happy Eid wherever you are in the world. Stay safe, and see you again next week. Bye.